Welcome to the Breaking Into Finance podcast. My name is Craig Thompson, and this is the open source field guide to help you understand everything you need to know about breaking into finance. Let's dive in. Hey, everybody. So as we start talking about not only like discount rates and DCF valuation, but also kind of like what private equity is, how LBOs or leveraged buyouts work, one of the core concepts in all of this is understanding the fundamental differences between debt and equity, the expected returns on those. And then today, I want to spend a lot of time talking about the Fed and the role of central banks in determining how much we have to pay when we feel like borrowing money for stuff. I don't know, Blaise, Olivia, I don't know if you guys like have any student loans or like have friends that do, but my wife had $70,000 of debt coming out of Middlebury. And one of the things that I feel like it like just lives under the surface with all of this stuff is what interest rate you pay on debt. And I feel like that's often kind of an abstract concept, but it's changed a lot just in the last year. Debt has gotten a lot more expensive, and I want to talk a little bit about why. And to start, have you guys heard of the Fed? Is that like a term that you guys have heard anybody talk about before?
Yeah, they spoke about the Fed in my intro to macroeconomics course, but haven't talked about it too much since.
Do you know what the Fed does, or how much do you remember from that?
Yeah, I remember the Fed sets interest rates, right? And sort of manages kind of the money supply in the country.
Exactly. Yeah. So the Fed is the central bank of the United States. Other currency systems more often than not have a central bank or someone that's determining how much of the currency exists in the world. And when we're talking about like dollars and like what's a dollar worth, there is a lot of stuff that goes into that. But the main thing that the Fed does that you'll like hear in the news is exactly right, Blaise, controlling what interest rate at which they will lend money to banks. And so if the banks can access money from the central government basically for free, then that makes it a lot easier for people to, or just anyone else, like companies, people, like whoever, to borrow from those banks at cheaper rates. And so the cheaper a rate that these like large institutional banks can borrow money, a lot of basically that savings gets passed on to everybody else. Because if you were a bank that was lending out money at whatever interest rate, but some other bank can borrow from the Fed at substantially less than that, it's easier for that bank to like outcompete the first one and basically give, loans to companies or people that is at more attractive rates. And as a result, across pretty much like how anybody borrows, a lot of debt is quoted on a spread to this rate. It used to be called LIBOR. Now it's called SOFR, SOFR. I won't go into why or what that change was. But if you were borrowing money at a variable interest rate, someone will basically try to figure out how much riskier are you than, something with no risk. And then they'll look at, okay, well, like, what is the interest rate for that risk-free asset? And then that's how they'll determine at what rate they'll lend to you. So if, someone says, hey, like your spread on this like 5-year loan I'm giving you should be like 5 percentage points higher than the risk-free rate, then what you could do is you could look at US Treasury, like 5-year US Treasuries, and see that those are trading at whatever, like 4% or 4.5%. And then they'll say, okay, well, your rate is 9 or 9.5%. So that is kind of like the core mechanic that the Fed has to influence interest rates. And so one question you might have is like, well, what does that do? So what do you think the impact of having very, very low interest rates, like 0%, interest rates might be.
Well, if interest rates are low, it would kind of encourage people to take out loans to buy things and whatnot.
Exactly. Yeah. Buy things. And not only that, but invest in projects. Like you might take out a loan to buy a house, but you might also take out a loan to try to start a business, or you might try to take out a loan to build, something that you might sell to somebody. And so very low interest rates makes borrowing cheap, and that encourages people to do stuff with that. And when you're doing stuff, that is always very good for employment. So that is in periods of recession or high unemployment, you are likely to see the Fed reduce interest rates as a means of improving employment. And this is part of like the Fed has a dual mandate. Basically, like the role of the Fed is to do two things. One is to control inflation and keep inflation at a healthy level, and we'll talk about what that is, while also managing unemployment and keeping unemployment relatively low. The fancy mahogany room economists who are leading the Fed and making these decisions do kind of explicitly take a view that some unemployment is good. Like if unemployment was zero and everybody had a job, then the idea is that it's harder to invest in new projects because there isn't this kind of pool of people waiting for work. There's a lot more delay and friction to hiring those people. So we can have a philosophical argument about whether that is really the right way to think about things, but the Fed generally is comfortable with some amount of unemployment.
What might that rate look like?
It varies based on kind of like what their view of the natural unemployment should be. But I think most people would view an unemployment rate under 5% as healthy and pretty good. I think the unemployment rate right now is something like 3.6%. It's like very low, like near historical lows. And so in kind of like recent modern financial history, I'm not actually aware of a time where people were worried that the unemployment rate was too low. And they were like trying to like bump up employment. Usually it's the opposite. Usually they're worried about inflation, which is the other thing we'll talk about, which leads them to raise rates, or they're worried about unemployment being too high, like 10% would be like quite bad by historical standards for the United States. And if unemployment is getting really high, then they'll try to cut rates to try to improve employment.
I have a quick question. Just like, who would particularly benefit if the Fed raises the interest rates? Because like, as you said, like as interest rates get higher, like employment could also get higher, but like who would benefit if the interest rates
it's up? A great question. And there are a couple of pockets of people that do, but predominantly if you subscribe to the Wall Street Journal or have over the last year and a half, you'll see that the equity investors are very upset and perturbed about all these rate hikes. And so then you might ask like, why do it at all? And the answer, especially in today's environment, is controlling inflation. So one thing that might happen if interest, let's just say like in a world where interest rates are zero or near zero, we already said a lot of people are going to borrow money. And banks pretty much always will lend out more money than they actually have. So low interest rates incentivizes borrowing. Borrowing is kind of, especially like if you're borrowing money on credit, like it's unsecured borrowing, that is inflationary, which is to say dollars are getting pumped into the system because we are borrowing from banks. Banks are borrowing from the Fed, and the Fed doesn't like have this stockpile of like gold or dollars that they're using to lend out the money. People are just saying like, it's the Fed, like I trust them. And by the way, if like the US government can't pay its bills, absent like political decisions to intentionally not pay their bills, we can just print more dollars, right? Like in a worst case scenario where you're wondering like what's going to happen, like there's this margin call, like the US government will just print more money. They will mint a $100 trillion bill, and all of the their debt issues will go away. But let's say that happens, like as this is happening, as people are borrowing money, as cash is getting pumped into the system, now all of a sudden people have a lot more money to spend on stuff. And that is often a fundamental driver of inflation, which is to say, if there is some scarce resource that all three of us want, like we're all trying to buy a particular mic for podcasts that we're all starting, and the microphone manufacturers only have a limited number of microphones to sell, like this month, the price of microphones will go up because they can sell them for more because there are all these people that want to buy them. And so having lots of money in the system is inflationary. Like it might be something that might cause inflation to increase. And so where we stand today is some combination of we've had rock bottom interest rates for a very long period of time. On top of that, there was this direct payment. There are basically a series of direct payments. I think it was like 3 or 4 series of direct checks that that both Trump and Biden paid to individuals to help get us through COVID. Which, by the way, like my personal opinion is that was hugely important for avoiding a major liquidity crisis. We can talk about liquidity crises in a bit, but there's no doubt that it was inflationary. And then on top of that, COVID created these supply chain snags where the flip side of all of us having money for a limited number of mics is if the microphone manufacturer is short some supplies that needs to produce them, even if we all have the same amount of money, if all of a sudden there are fewer microphones because there's a supply chain constraint. And this happened a lot with like cars was like one example, is there was like a water shortage in Taiwan that limited their ability to produce microchips at the Taiwan Semiconductor Corporation, which is the largest producer of microchips. That led to a constraint in smart car manufacturing. So all these like auto manufacturers couldn't sell or make as many cars as they wanted. And that led to the price of cars going up. So there are a couple sides of this coin, but the kind of like high note here is that inflation can be dampened with hiking interest rates, because hiking interest rates does the flip side of pumping money into the economy. It kind of like sucks money out of the economy, or reduces the rate at which money is getting pumped into the economy. And that is meant to ease that inflationary pressure. Another question you might ask is like, why is inflation bad? And by the way, why does the Fed has a stated target of 2% inflation? Why is any inflation good? Like, I think both are legitimate questions. Like, what do you guys think?
Could it be because it encourages people to, like, I guess, repay their loans?
That's part of it. Yeah, I mean, repaying loans, you're contractually like you have to, but it's related to that in the sense that it's about savings. And if we have if we have a massively inflationary environment, and there are a couple of countries that like around the world that today, like unfortunately really struggle with hyperinflation, like Venezuela is one kind of like prime example. Incentives to work get reduced if the value of your paycheck goes down the second you get it. Like, that is to say, like, if inflation is like 100, like as inflation gets higher and higher, people value money today less and less because they're like, well, like, I got my paycheck today, but it's all going to be worthless next year, or it's like not going to buy me anything. On the flip side, in a deflationary environment or a 0% inflation environment where the price of goods are structurally going down over time, the issue you run into is now just saving your money and hoarding your money becomes attractive. And you can generate a real return by just holding your money in a bank account. And that disincentivizes investment. Basically, like, if I can get a 10% return on my money by like doing nothing with it, which is sort of a funny concept, but you can imagine, like, I have a bunch of money and we'll call this my coffee fund. Like, I have a separate pool of money. I'm a coffee addict. I need to buy coffee every day. And I don't want to worry about how I'm going to afford my coffee in the future. So I have this coffee fund where the job of the coffee fund is to like earn a return to ensure that I can buy my coffees in the future. In a deflationary environment, the price of coffee is structurally decreasing over time. So the same cup of coffee that costs, whatever, $3 today might be $2.80 next year, $2.60 the year after. And so I can earn a return on my money by just doing nothing with it. And so people will do that. And that stifles investment, which stifles growth, which is bad for a host of reasons. And so the Fed has basically decided, and a lot of these central banks have kind of decided, that a small amount of inflation is actually good. Because if your dollars are structurally getting less and less valuable over time, that incentivizes you to invest your money so that you're earning a return to keep up with the pace of inflation. Balancing that against runaway inflation, which can lead to people not valuing their savings enough and therefore like not working. And so there might be all these people that like want to invest money, but like nobody's willing to work for it. So that's a little bit about the Fed. And there are central banks all over the world that do this stuff. The EU has one central bank, the ECB, the European Central Bank, because they have one currency, the euro. And then like the UK has the British pound that is a separate currency. So there's a separate central bank in the UK. Canada has a central bank. At a time a couple of years ago where everybody was like talking about crypto, one perceived benefit of crypto was that there was no central entity that could artificially, decide interest rates need to change for whatever reason. And so people liked that decentralized component. And there was algorithmic inflation that basically like changed the rate at which things could be mined. And there was an upper bound to how many Bitcoins could exist. So there was a headline, this is maybe 2 years ago, I think El Salvador recognized, and I think still does, accept Bitcoin as national legal tender. And part of their argument was like, they were all mad at the US for creating inflation through direct payments to US citizens that did nothing to benefit El Salvadorians. But the inflation made their dollars weaker, so it kind of like hurt the value of like what they were using as the dollar relative to other currencies. And kind of like Bitcoin kind of helps avoid that problem. So I know it's out of vogue now, but that was one interesting property of some kind of like algorithmic currency.
Craig, just as an aside, you were at El Salvador, but the New York Times just had an article published recently titled "A Poor Country Made Bitcoin a National Currency. The Bet Isn't Paying Off."
Yeah. Well, that's also like, I think some of it is that it's like a very inefficient thing to use. And then there's like all those like infrastructure issues of like, if it's like a national like legal tender, do all of these like stores have to like figure out how to accept it? The price of Bitcoin, of course, plummeted like massively since that. So the volatility in the price of that currency does not solve the exogenous inflation problem that they're worried about. Like there's a whole host of like other big problems that come with volatile currencies. But that's, by the way, people like currency stability too. And a lot of countries actually peg their currencies to the dollar for the purposes of stability. And that is to say, like, inflation, deflation, instability in your currency often leads to a bunch of like bad knock-on effects. And then, Olivia, you were also asking like who benefits from from like reducing inflation, or like, like why would the Fed ever like hike rates? Like who benefits and who doesn't? One kind of interesting phenomenon is that there are two sides of a lot of these loans. And so lenders who lent money out at a floating rate and now like rates are getting hiked, like the returns that they're making are going up. So like student loan issuers like SoFi, insofar as people can afford to make their interest payments, like they'd be worried about people defaulting on loans. But insofar as people aren't defaulting on loans, the combination of like the Supreme Court striking down the student loan forgiveness program plus rates going up is amazing for these lenders that have a lot of floating rate debt that's out there. On the other side, it's like everyone who's been borrowing money is now being forced to pay a lot more than they might have expected that they would. So that's a little bit about the Fed, and that's a little bit about interest rates and how the Fed can influence interest rates. And we are very interested in this topic from a company valuation perspective, because as we've said, like as we think about how companies make decisions about whether to invest in projects, the cost of borrowing money or of like giving away shares in exchange for cash, like basically like giving away equity or like borrowing debt for your company, is like how you would get that investment. As the cost of borrowing goes up, so as interest rates get hiked and the cost of debt goes up, that impacts valuations. And that, by the way, was a big part of the market correction of 2022, was twofold. And like some people like think it was like the prospect of recession. That's not the driver of what happened. The driver of what happened is that people fundamentally changed how much they value cash flow expected to be generated in the distant future. So you would see all of these like crypto projects, like space manufacturing companies. Artificial intelligence has happened a lot sooner than maybe people would have thought in 2021, but like kind of like all of these high growth opportunities that are totally unprofitable today, but have the promise of profits in the future. Interest rates getting hiked makes it more expensive to invest in those projects. And so the value of those future dollars is reduced.
Just to clarify, so since like the interest rates now are going up and like you're not going to see, I guess, profit from these projects you're investing in like in the near future, that's why they become like the dollar becomes less.
Exactly. Yeah.
Okay.
So you could think about how excited you would be to borrow money to invest in a project that will churn off a bunch of cash flow in 10 years, but nothing before then. You have to make these higher interest payments every year for each of the next 9 years while you wait for that project to come to fruition. So your eagerness to pursue this path and pursue this project goes down as interest rates go up, right? Because if interest rates go up, then you owe more in interest over the next several years while you wait for this project to take off. So that's kind of like the fundamental relationship between cost of borrowing and the future value of projects. We've talked previously, but just we'll talk again about it here, how the cost of equity is almost always going to be higher than your cost of debt. Like basically like borrowing money, if you're able to borrow money, is cheaper than giving away equity. And the primary reason for that is that the equity is riskier. So if you can imagine a world where we're talking about this same hypothetical project, like it's going to be great in 10 years, but like zero or negative profits for the next 9 years. And I was talking to lenders and I was talking to equity investors. Like I was talking to both because I want money to fund my project. Let's say that you're the investor and you make both equity and you make debt investments. and the company came to you and said, hey, like in 10 years, like I think the value of this business is going to be, you know, however many millions or billions of dollars. I'll do a bunch of math for you, and I will tell you that I expect the, you know, the return on your equity investment to be something like 15% on an annualized basis. And you're like, okay, that's great. And then you're like, so like you can, you know, buy some equity in my company, or I'm also seeking loans. And I am willing to give out loans at a 20% interest rate. As the investor who has the choice of equity that you expect to generate 15%, but you don't know, it's volatile, or a debt investor who's going to get 20%, as long as you believe that they will have the money to keep making your interest payments, you will always get paid. Well, first off, you will always get paid before the equity investors, right? Like you have a contract for 20% interest, and the equity investors, like there's this fancy model that says 15%, but nobody really knows. 100 times out of 100, I'll be a lender in that deal. And I'll get a higher interest rate with the guarantee that I get paid first. There is no world where I, as a lender, don't make my full return and the equity investors even get a penny. So that's sort of how the market shakes out. It also like works backwards from like, what's the cost of borrowing? And as the cost of borrowing goes up, then the expected returns on equity also will go up. The interesting thing, right, is like we have companies that maybe have the same projections that they had a year ago, but the cost of borrowing has gone way up. And so what does that mean? That means if you were an investor who's like new to the party, the price per share at which you're willing to buy stock has gone down drastically. Because if you could invest in the debt of these companies at some very high interest rate today, and you have these projections that say the company will be worth, you know, whatever dollars per share in 10 years, you can work backwards and say, okay, to earn a reasonable return on my money, if all these projections come to fruition, I need to pay a price per share that is a lot lower than the price per share was a year ago. I know that's a lot to throw at you, and it's weird. It's funny to think about how you, as an existing shareholder, could invest in a company where the financial projections of the company don't change, but rising interest rates cause the value of your equity investment to go down. But what it really comes down to is if rates go up, then anyone who you might be selling your stock to would demand a lower entry price such that their expected return, which you expect to be like the same dollar value in however many years, compensates them relative to the incremental yield that they could get by investing in debt. So that's how hiking rates affects the valuation of companies that don't even have any debt. Like you don't have to have debt for this to be true. But if you do have debt, then it's even more true, especially if you have floating rate debt where your interest expense is going up as rates are getting hiked. Because as interest expense goes up, what happens to profit?
Goes down.
It goes down. Yeah. And there's an article recently, it's almost like kind of an alarmingly large number, that of private equity backed companies that have publicly available debt, don't worry so much about those qualifications if you didn't follow like publicly available debt and private equity. Don't worry about that. The punchline is that there is a pretty large cohort of these companies that at one point were owned by a private equity fund where interest expense is 43% of their EBITDA. That means that these businesses, they have like thousands of employees. They're like working really hard to like produce a great product and make customers happy. And they're doing all this stuff and they're generating this EBITDA, this kind of like operating profit before depreciation and amortization. And then half of that pool of money they're making every year is going to bondholders. 43% of that is going out the door in interest expense, even before any of it goes to equity holders. And, it's sort of like boo-hoo for these like private equity funds and these like fancy like equity investors. But one, that is a big destroyer of value when like interest rates going up might cause interest expense to go from like 10% of EBITDA to like 40% of EBITDA. Like it's a pretty big hit of like earnings decline. The other thing that it does is it reduces the cushion that these companies have between when they're like profitable and like free cash flow positive and when they're not. And so that just puts them in a slightly more precarious situation, so that if we do get a recession, if we do get kind of a broader macroeconomic downturn and EBITDA declines, interest expense now erodes even more into that value. And that's where you kind of risk the potential of like bankruptcy. And so that, by the way, like that plus the experience we saw with like First Republic and Silicon Valley Bank is why when the Fed hikes rates, they try to do it relatively slowly and incrementally and predictably, so that there aren't these huge, like massive shocks to the system where like people were managing their business around, whatever, interest expense being 10% of EBITDA. And then all of a sudden it's like blown out of the water.
Craig, I have a random question. Obviously, the Fed can control interest rates. How often do they make changes? I'm sure it kind of depends on the time period, but what does that look like in general?
They make changes pretty often. They meet to discuss interest rate changes every 6 weeks, approximately. And so that's like, would be like the fastest cadence. And a lot of times in the news where you hear about like how much of a rate hike they will do, there's no like reason that I'm aware of like why this has to be true, but they tend to think about interest rate hikes in quarter of a percentage point increments. So if they were setting interest rates at 4%, they might debate whether to leave it the same, or raise it to 4.25%, or reduce it to 3.75%. Over the course of the last 2 years, we've seen not only like 0.25% rate hikes, but we've seen like 0.5 point or 0.75 point rate hikes too. So at a meeting, they might decide we're not just going to do 0.25 point, we're going to do double that or triple that. But unless there was a true emergency panic and they had an emergency meeting, they wouldn't like change it week to week. And it is very rare that they would change it by more than 0.5 point in any particular session. These rate moves happen like pretty reasonably. Like there might be like a full year where they don't do any, or maybe they do one. But I think last year they hiked rates, I think maybe like 7 times or something like that. Like there were more meetings that led to a rate change than not last year. And it's a really hard job because it's not like all of this happens right away. And this is the other thing that I really want to emphasize for listeners who are like trying to understand this world of finance is people like to put a single number on things. And so like that's the core competency and skill set we're building, is take a set of really complicated real world objects and people and movements and put a dollar value on it. But the flip side is when you're looking and seeing like, oh, like the Fed hiked rates by like 0.25 point, so I should expect inflation to change by like 0.2% or like whatever. It turns out that first off, like inflation is like a really complicated number, and changes in inflation happen in very unpredictable ways. Like I think like a common phrase that you might hear is long and variable lags, where the Fed might take some action and they know that there's a lag between when they take the action and when the economy responds to it. And it's a variable time frame. Like they don't know if it's going to like The reaction will happen over 2 weeks or over 2 months or a year. Because you can imagine, like, there's like a whole lot of steps that have to happen for this too, right? Like, inflation is comprised of a bunch of things, but like one part of the inflation basket is like the price of milk at a grocery store. And if you're thinking about how like the Fed can influence the price of milk or changes to the price of milk at a grocery store, and they're like, wow, like milk is like 10% more expensive than it was last month. Like, this is terrible. We want it. Like, how do we change that? First off, the price of milk just fluctuates with like cow production. And like, if there's like some cow disease, that impacts the price of milk. Distribution or like supply chain issues can like change things. But then also it's like, okay, like the Fed hikes rates. So that makes changes to interest rates, which changes the cost of borrowing. So perhaps these large dairy farms it might be more expensive for them to expand their facilities or to pay for food to support the cows. And then maybe those higher costs get eventually passed along, when the milk eventually gets sold. So there's all this stuff that has to happen, and it's different things that have to happen for each good that exists. Like, that ripple effect for groceries is different than the ripple effect for cars, is different than the ripple effect for like energy and gas prices. So this is all really complicated stuff, and the Fed sort of does its best with it. But the core takeaways that I hope you guys get from this is, one, the Fed is a dual mandate balancing inflation and unemployment. Equity markets hate it when the Fed hikes rates because it makes these like far off cash flows less valuable. But also they understand that it is an important part of controlling inflation. And if the Fed just totally ignored this problem for years and years, then we risk running into hyperinflation, which really kills growth and is like even worse for all these companies. Balancing that against not wanting to have total 0% interest rates forever. Zero interest rates is like the hyperinflation example versus like very high interest rates is, one, bad for valuations. Two, if people are reducing the number of projects they're investing in, then that means that they're hiring fewer people for these projects. And stock prices going down plus fewer projects getting done is bad for labor markets.
Craig, have we ever experienced hyperinflation in the US or gotten close?
Not nearly to the extent that some other countries have. The worst inflationary experience that the US has had in recent history was in the 70s and 80s. A lot of that was driven by gas prices and like gas shortage. Like, I don't know if you guys ever heard stories about, like, in the 70s, OPEC, which was, it's a group of countries in the Middle East that really controlled oil production in the 70s. Like, the US was not a major energy producer at the time. They really, in an effort to basically like make a lot of profit on their oil, they severely capped oil production. And that led to the cost of gasoline getting really high and also really long lines. Like, there were like, depending on like the letter at the end of your license plate and like what day it like corresponded to what day you were like legally allowed to get gas. Like, there's just like crazy stories about stuff like that. And yeah, so I think in the 70s and 80s, I think interest rates in the US, like treasuries were high in part because inflation was high, but I think it was in like the 10 to 12% range. And then kind of like gradually came down over the next 30 years. This recent inflationary spike is like the worst, biggest spike we've had in recent history, but relative to the experience of like us 40 years ago and like other countries today, the inflationary level wasn't in and of itself like a massive problem. But if there's a lot of recurring inflation, people tend to expect it. And expectations of inflation often perpetuates more inflation. Like, if I think that prices are going to go up, then one, when the grocery stores raise the prices on me, I'm not surprised and I don't complain. And I'm more complacent about it. And then, and that just leads to like expectations of inflation becoming more endemic.
I always find the macroeconomic stuff pretty, or at least for me, like more interesting and engaging than the micro stuff, but that's just my background.
No, absolutely. And it's like a lot of the, like, if you understand the macro, it makes the intuition in the finance jargon a lot easier. Like it's a lot less memorization and it's a lot more like, oh, this makes sense.
Yeah.
But the role of interest rates and like borrowing, like the cost of borrowing, like that, like why people decide that like that should be part of how we discount future cash flows is not super obvious to people. And even in the world of like people who like have built like thousands of DCFs and like have memorized how to build it might not have a good conceptual understanding of why the relationships are true. They know how to make the formulas, but they don't necessarily know why.
That does it for today's episode. Thank you so much for listening. And remember to check out our website, breakingintofinancepodcast.com, where you can submit questions, join our Substack to stay up to date on new content releases, and much, much more. We'll see you next time.